Wait, what? I can do that? This is Eric Bell with Wait, what? Financial matters that matter for business and the people that own them. I'm fortunate today to have a returning person with me, Shawn Bragdon, who is the managing partner for BGA Insurance here in Irvine, California, Costa Mesa, California. Shawn, welcome.
Hey, thanks for having me, Eric.
Rule number one, this is Karen. If you're using the acronyms, you got to put $5 in the slot.
Okay.
So IUL, CV, all that stuff out the window. You got to tell us what that stuff means. So our viewers know exactly. Yep. I got you on today to talk about premium finance, and you and I have done traditional premium finance, and there's a new thing out that we've been talking about that I'm exposed to, but I want to talk about traditional premium finance first, how that works, and we did an episode on that before, but I want to talk about it again so we can contrast the two.
Yeah, okay.
So with traditional premium finance, how does that work?
Well, so basically, traditional premium finance has probably been around for 20 plus years, and it's really the most cost-effective way to buy a large life insurance policy. Rather than using 100% of your own money to buy a life insurance policy, you can use somebody else's money.
Right.
And with traditional premium finance, the client is going to have to, apply for the loan. Client's going to sign a personal guarantee, and depending on the client's credit worthiness, that'll dictate what kind of lending terms they're going to get. And traditional premium finance was typically used for estate planning needs. You have a client that has a very big net worth. When they die, the family might have to sell their business at a bad time or sell real estate at a bad time, and so you have this large life insurance policy that can be used to pay estate taxes rather than to sell potentially illiquid assets. And large life insurance premiums often would create gift taxes, and the premium finance option, by borrowing money to pay life insurance premiums, you're able to avoid gift taxes. And there's certainly some big benefits with premium finance, and there's also some challenges with premium finance. And some of the challenges are, you got to go through medical underwriting.
Right.
You have to go through financial underwriting. Most of the major insurance carriers won't let you use their product in a premium finance situation unless you have a net worth of 10 million or more. Some will come down to 5 million or more. And typically in that traditional premium finance space, I just don't see many transactions going on unless the client does have a net worth of 10 million or more. Because, it's complicated. There's a lot of moving parts. You have to have outside collateral, and you got to be able to, handle a curveball along the way. The product didn't perform quite as we expected, or interest rates climbed. You're gonna have to post some additional collateral, and smaller or younger clients maybe can't handle that type of curveball, and that's kind of where you are with traditional premium finance.
Yeah, it was a pain in the ass for a couple of my clients because every year they have to present financial statements.
Yep.
So and they're busy running their business, they don't really have time to do that, but it seemed like to keep that loan, they have to, or to get the next deposit to the premium financing situation, they have to present some more financials.
Correct. With a traditional premium finance transaction, typically the loan term is going to be 3 to 5 years. Even though it's a 3 to 5 year loan, they call it annually renewable. So your client's going to have to show, financial statements and maybe tax returns every year, at least financial statements, to make sure that, the bank's happy with the way things are going.
And it's a laborious process. I remember folders being that thick.
Yep.
Because of all the stuff that we have to document to go ahead and make it happen.
Yeah, but then there's a big upside. For typically, you can get a large life insurance policy for maybe 30% of what it would cost you if you just cut a check. Mm-hmm. And so you're saving a significant amount of money, and there's more risk involved, but with the right client, the benefits outweigh the risk.
Well, most of the clients we have, they understand risk and they understand leverage.
Yeah.
That's basically what you're doing, is leveraging a policy.
That's exactly what you're doing. You're leveraging. And with the traditional premium finance structure, it's often like a 10-to-1 ratio, so for every dollar of contribution that you put in, and your contribution might be paying loan interest, it might be paying some of the premium, it might be a combination of paying some of the premium and loan interest, but it's often, somewhere around a 10-to-1 ratio. So for every dollar you're putting in, you got 10 working for you.
So, something I'm excited about is Kai-Zen. You introduced it to me, I'll say middle part of last year.
Yep.
I thought it was phenomenal. It's probably almost too good to be true. You know, a lot of stuff you talked about with traditional premium financing didn't exist.
Yep.
Also, your entry level was a lot less.
Mm-hmm.
And it seemed like it's ideal for people between the ages of 30 and let's say 50, 55 latest, but 50 maybe.
Correct. Kai-Zen, the Kai-Zen plan is a unique, I will call it a premium funding plan, because it's
premium funding, not financing.
Yes,
Okay.
because what makes it unique is, first off, you're now allowing people that have much smaller net worths access to this type of strategy. You know, as I mentioned, with traditional premium finance, typically, you know, you got to have a net worth minimum of 5 million, and most insurance carriers it's 10 million or more. Mm-hmm. With a Kai-Zen plan, you can get involved in a leveraged retirement plan, and the only requirement is the household income's 150,000 or more. That's it. Wow. That's it. And with the Kai-Zen plan, you're not completing a loan document. You're not signing any personal guarantees. There's no collateral other than the policy itself. And they've stress tested this plan so that it has a high probability of doing what you're proposing. Most of the plans are designed for supplement retirement. Mm-hmm. You know, that's the reason they're doing this. You know, for every dollar you're putting in, you have $3 working for you. So you have a nice amount of leverage, and they're using what's known as an index universal life product, where they're able to, you know, have that money grow tax-free and then access it tax-free down the road.
So, you know, what's the minimum that you can put to the Kai-Zen?
Well, the minimum is going to be based on your age and underwriting class. They'll issue policies up to age 65. And so the requirements are you have to at least be able to get a standard underwriting class. You still have to go through medical underwriting. But, you know, a younger individual, you're talking about, you know, $25,000 a year annual contribution. They can get involved in the program. And basically the way it works is, you know, a typical client might say, okay, I'm willing to put $50,000 a year into this plan, this leveraged retirement plan.
And they need to commit to that for 5 years.
Yeah, they need to be able to make a contribution for 5 years, 5 premium payments, and that's important. You know, if your client says, hey, I think I can do 100,000, you got to say, no, let's make sure you know you can do 50 or 75,000.
Right.
But the way it's designed is the client's going to contribute, let's say, $50,000 a year, years 1 through 5. Mm-hmm. All right. The lender is then going to loan that client $50,000 years 1 through 5, and then $100,000 years 6 through 10. And so in my example, the client's putting in $250,000 over 5 years, but he's got $1 million working for him. Mm-hmm. And client doesn't pay any loan interest. Client does not post any collateral over and above the life insurance policy. And in year 15, there's enough money in the policy that we're going to take out a policy loan out of the policy, pay off the lender, and the client walks away with a ton of money in a tax-free environment.
You know, I was shocked when I saw those illustrations. You paid off the loan, and it still had enough money to give you a substantial tax-free income stream.
Yep.
Yeah. Wow.
And there, you know, there's also some added benefits. Of course, you know, you have a death benefit, mm-hmm. and you're going to have a much larger death benefit than what you would normally have if you just put $50,000 a year in for 5 years because of the leverage.
Right.
And all the products that they're using in the Kai-Zen plan also have a free chronic illness rider. Oh, so if you get hurt or sick, you know, you can tap into your death benefit tax-free.
Prior to year 15.
You have to pay off the lender before you can access the benefits in the policy. So that is an issue. You got to get it done by year 15. But you do have the option of paying off that loan early if you wanted to use outside assets. Maybe your client, you know, sells their business. They have, you know, liquidity event. They don't have to wait till year 15. They could pay it off early if they wanted to. And the sizzle here is with traditional premium finance. In order to get good lending terms, you're going to have to borrow like $1 million out of the gate in order to get good lending terms. And what I mean by good lending terms, lending rates right now in the premium finance space are somewhere between 1.5% to 3%. The Kai-Zen plan, you're able to borrow at 2.75%. And the reason you're able to get good lending terms with the Kai-Zen plan is once they get enough like-minded people that want to do a Kai-Zen plan, they pool them all together and they do one tranche. So you have 30 guys that want to do $50,000 a year contribution. Once that total outlay hits 2 million or more, then the Kai-Zen plan does one tranche. They fund all the policies, and you're able to get the best lending terms, which is unheard of in the space. I mean, typically, if you want to, borrow 50 grand a year, you're not going to get good lending terms, and that's the key in any type of premium finance structure. You got to have, a decent lending terms, because the whole premise is the returns on a cash value life insurance policy historically exceed the lending rates. Mm-hmm. And as long as that arbitrage, goes forward, you're going to win. I mean, that's how it works.
Let me understand something on the tranches, point of clarity. So I signed Shawn Bragdon up today. Uh-huh. They closed out a tranche last Friday. I signed you up today on Monday. Even though you got approved medically and all that kind of stuff, I got to wait till there's $2 million in that tranche before the money's.
Correct. They're doing tranches about every 6 weeks.
Okay.
And so, typical medical underwriting is going to take you,
it's going to take
4 to 6 weeks anyway. Right. So,
there's no delay for the most part.
There's no delay. I mean, there used to be. They've been doing the Kai-Zen plan for about 5 years, but now it's been marketed all over the country. So there's a lot of people doing it. And the other thing is they're doing it in Nevada. And the reason they do it in Nevada is because Nevada has better asset protection rules. Right. Anyone that owns a policy in Nevada, that your cash value is protected, your death benefits protected. And what they do is they have a master trust in Nevada that in essence is borrowing money on behalf of your client. Mm-hmm. And that's why your client does not get a debt on their personal balance sheet when they're doing a Kai-Zen plan. I mean, that's pretty amazing, where in my example, the client's, borrowing $750,000, putting in $250, borrowing $750, having $1 million working for them, and yet they have no debt on their balance sheet, because right. Technically there's this trust in Nevada that is borrowing it on behalf of everyone, and everyone gets their own trust or sub-trust inside that master trust when they set up a Kai-Zen plan.
That's what I was going to ask you. We had a pandemic like we're in. We had a lot of people passing away, but you didn't pass away. Would that have an adverse effect on your policy? I guess not, when you have that sub-trust.
Well, the trust is either a revocable trust, which is what most of them are, because right. you're tapping into this thing for retirement income typically, or you could set it up as an irrevocable trust. But there is a death benefit. If you die early, that's what it's for.
But that's the insurance company handles that, not the Kai-Zen.
Yeah, the insurance company is covering that.
And I saw we got a couple big names. We got Alliance.
Yeah. The carriers Allianz that are currently that have approved the Kai-Zen plan include Allianz, National Life, Securian, and Emeritus.
Oh, wow, those are big companies.
Yeah.
So let me understand right. Let me just recap. As far as contributions, the first 5 years, you're going to be matched.
Correct.
So if you're putting in 50, they'll put in 50.
Uh-huh.
The remaining 5 years, they're going to put in what you could have put in, that 50 grand, plus they're going to put in an additional 50 grand.
Exactly.
So it's 3 to 1, 300% return before you even do anything.
Yep.
Wow. Yeah. That's pretty good.
Yeah. And in technically, let's just say zombie apocalypse happens, mm-hmm. and this thing goes completely sideways. Mm-hmm. Technically the client is not on the hook for that loan. The bank is. Mm-hmm. And that's what was really startling to me, is now, why would the bank be willing to take on that kind of risk? I mean, they are collateralized because of, the policy's cash value. But the stress testing that has been done on this Kai-Zen plan has provided that extra level of comfort for the lenders that are involved. So, for example, they did a stress test that, okay, let's assume we got returns like the 1930s depression. And they're assuming that, you got 9 negative years on the S&P 500 out of 12, and yet you're still able to pay off the lender and have a nice retirement account. And then what if interest rates go up? Because your lending rate is not locked in. It's a moving rate.
Okay.
It changes every year. And they said, okay, what happens if we had interest rates like we had in the 80s, where you had, double digit CDs. You can get a CD for 15%. Well, they assumed interest rates climbed up to 18%, and yet you're still able to pay off the lender using the cash value in the policy, never pay any loan interest, and still have a retirement income stream. And so the banks were saying, hey, those are some serious stress tests. We're comfortable with this. We're willing to lend on this type of platform.
Now, within the insurance policy itself, is the agent still responsible for managing the portfolios within that policy, or does Kai-Zen do it?
Well, when you first set up the policy, you're going to select some index strategies on your index universal life product. In fact, that's what's used. It's an index universal life product, which gives you the upside of an index like the S&P 500, but you're contractually guaranteed to never have a negative rate of return.
That's right.
And so most of these products will have anywhere from 3 to 8 different index strategies you and your client can select. And so that's really up to you and your client on which index selections you want to choose. And they're almost all of them are annual point-to-point index strategies. So you can change that every 12 months.
Okay.
Yeah.
Every contract year.
Yes.
Yeah. So let's talk about insurance in general, Shawn. We had the pandemic. It's still going on, I guess.
Yeah.
How does that, in terms of underwriting, what's going on now with COVID?
Well, when COVID first hit, there were quite a few companies that were, I would say, freaking out. They were a bit skittish on what type of applications they were going to take. There were some carriers that, they wouldn't take any applications for people over age 70. They wouldn't issue a policy if someone had some slight medical conditions. They would say anything over a table D, which would be a 200% mortality rating, hey, we won't issue a policy. But that's changed. Right now, it's business as usual. Okay. There aren't any limitations on any of the carriers that we've been working with on age, or if a client has some impairments, they're still issuing policies. So at this point, it's business as usual.
But COVID's one of the questions on the policy, on the questionnaire to get a policy.
Yeah. Well, there's a combination of not only medical questions on the application for the life insurance company, but when you're doing an insurance exam, they're asking medical questions, draw blood, urinalysis. And so, yeah, that topic does come up.
I got a situation. I got a guy who's not vaccinated, caught COVID, still not vaccinated, believes he has the antibodies to fight off anything that comes. Would that be a decline in his case?
They're not asking if you got vaccinated or not.
Okay, cool. Cool.
No.
All right.
Well, they're just, if you have COVID and you're having problems with it, that's gonna be a postpone until
they don't want to buy into
until you've recovered.
Right.
Yeah.
Right. Other than that, any other changes that have happened?
Not at this point. It truly is business as usual. Yeah.
Okay.
And in fact, what's happened in a very positive way is now you have a lot of insurance companies that have accelerated underwriting, where you have, a 50% chance of not having to do an insurance exam if you're 60 and younger, and the death benefit is $1 million or less. And what they do is, they're going to ask you medical questions. They'll do a prescription database check. They'll check your motor vehicle record. There's another thing called the Medical Information Bureau. They'll check to see if you've applied for insurance elsewhere, and they check all those things. And then, you got a decent shot of not even having to, give blood or urinalysis or doing that insurance exam. So that didn't really exist as much as it does today. I mean, virtually every single carrier now has an accelerated underwriting platform now, and they didn't used to. And so it's making it easy. You can do electronic signatures. You don't even have to go see the client, face to face. And so that's, I guess, one of the advantages of the COVID is, you can now get applications done just with phone calls and emails.
So, you're putting in that 50 grand, or let's say you made a mistake. You thought, okay, I can do 100. Something happened in the economy and you had to pull back to 50. Can you do that within the Kai-Zen?
No.
Okay.
No. I mean, what's going to happen is if you can't make all 5 of those premium payments, they're basically just going to surrender the policy, and they're going to pay off the lender, and you'll keep whatever's left over. And these are are products that have what's known as an early cash value rider. So they've eliminated the surrender charge that's on, a traditional permanent life insurance policy. And so with these early cash value riders, these products are very liquid. So you do need to have that commitment fulfilled, though. If you say, hey, I'm going to put $50,000 a year in for 5 years, you got to be able to do it. Otherwise, they will just surrender the policy and pay off the lender.
And the case design on the policy is the minimum insurance wrapper.
Correct.
To keep it all tax favored.
Correct.
Okay.
Yeah. And you can put any number you want. On the upside, they've had people that have put $1 million a year in years 1 through 5, and then they're going to borrow another $1 million. You can do big, giant deals like that. And in fact, they even have a nice little website that has, animations and videos on how the process works, and it gives you the ability of doing a bunch of what ifs. What if I put in $75,000 a year, or if I want to put in $125,000? What's going to be my benefit? And it'll instantly show you that on the website.
Now, for the business owner who has some key executives, wants to do it for himself. I mean, this is not ERISA.
Nope.
So if he wants to do it for 4 or 5 of his executives, he could do it also?
Absolutely. It's completely discriminatory. Okay. So he could pick and choose, some key people that he wants to do this type of structure for. Absolutely. I mean, there's even options where you could get guaranteed issue in the business market. So if you can get enough lives, it's typically 10 lives or more, and the executives need to be making at least $100,000 a year to get the guaranteed issue. But yeah, you can get guaranteed issue in that space.
I'm thinking about a real estate company where they're all making about 100 or greater.
Yep.
This would be a good fit for them.
It could be. Yeah.
Yeah. And when you look at the distribution is going to be tax-free if you do it right.
Money grows tax-free, can pull it out tax-free.
You got the 300% return because they're matching you and paying the last 10 years or 5 years.
3-to-1 ratio.
Yeah. I mean, I'm trying to figure out, why would you do this versus why would you do a 401k if you could do this?
Well, this will outperform a 401k plan. It will. I mean, a 401k plan would have to be getting consistent returns north of, say, 13-14% a year to compete with this leveraged retirement plan using a life insurance policy.
When you're limited in your contribution.
Yep.
And they're going to force you to take it at a certain time.
Yep.
Yeah. Wow.
No, it's a pretty attractive retirement plan. And you think about the fact, okay, there are very few products that you can enjoy tax-free in this country. I mean, in my opinion, I think tax rates are going to go up. All right. And so you pay your taxes now, put it in this leveraged retirement plan. You'll never pay tax on that money again. I mean, right now, 37% is the top federal tax rate. That historically, that is a low tax rate. The average top tax rate in this country since the tax code started in 1913 is actually 57%.
Oh, yeah.
So odds are tax rates are going to go up. You're rolling the dice to see what tax rate you're going to be in your 401k plan, 15, 20 years down the road. Pay your taxes now. We're in a low tax environment. Put it in this leveraged retirement plan, the Kai-Zen plan. You'll never pay taxes on that money again.
Yeah, I agree with you. I think taxes are going to go up. Everybody thinks taxes are going to go up.
Yeah.
We spent so much money on, first we had a lot of debt to start with.
Yep.
Baby boomers are getting older, not dying. It's just, and we don't have enough taxpayers because all the baby boomers had less children than their parents did.
It's all true. And right now, what do you have? You got municipal bonds. All right. Well, you maybe get a 2% yield today. You got a Roth IRA, which you can contribute $6,000 a year into, unless you make over $193,000. You can't use a Roth IRA. And you got cash value life insurance. That's it. Anything else you put money into, you're going to pay tax on it at some point in time.
And a lot of people are doing 401ks with a Roth in it or something like that now. Yeah.
Nothing wrong with that. Roth 401k. I mean, that's a good plan. It is a good plan, but you're limited on how much you can put in, right? Right. Can't access it until you're 59 and a half without a penalty tax. And it's not self-completing. You say, hey, you tell your spouse, we're going to have a great retirement. You start contributing money to your Roth IRA, and, next year you hop on the wrong plane, boom. Right. Where with a life insurance structure like the one we're describing, it's self-completing. Boom, there's a big death benefit if you die early.
Well, with the others too, they're considered provisional income. Where life insurance is not considered a provisional income.
Yep.
Yeah. So, and people don't know that messes up your Social Security check.
That's right. Municipal bond income
Yeah.
will mess up your Social Security check. Yeah.
Any deferred type of stuff in municipal income.
Yeah.
All right. Anything else, Shawn, we should know
Well,
about this?
I mean, it is complicated, and one way that I like to try to describe what it is, you say, hey, did you own a home? And your client says, well, yeah, I own a home. And you say, well, did you get a mortgage on that home? And he says, yeah, I got a mortgage on that home. Well, why'd you get a mortgage? Well, I couldn't afford the house if without the mortgage. Oh, so you wanted a bigger house, right? And that's in essence, what getting a mortgage is. Well, did you know you can do the same thing with a retirement account? You can get a mortgage on your retirement account to have a larger retirement account. That's really what we're talking about, with this Kai-Zen plan. It's just a leverage or getting a mortgage on your retirement account.
Well, and let's say you're in it 5 years, you made your 5 payments, or let's say you made 4 and you passed away.
There's the big death benefit for your family.
So they'll recover their loan from the death benefit, pay the difference to the beneficiary.
Correct. There's what's known as an increasing death benefit. So the death benefit plus the cash value is going to be paid to whoever are the beneficiaries. In this example, until the bank is paid off, there's 2 beneficiaries. Whatever your client's beneficiary was, let's say the spouse, and then the bank gets what they're owed first, and the spouse is going to get what's left over. Okay. And there's a sizable death benefit.
Right.
We're talking typically, the minimum death benefit on the Kai-Zen transaction is a 1.5 million. That's the minimum you can do.
And one thing I like about the Index Universal Life is that you have a floor of 0. So we have a down market like we did in 08, 09, where the markets are down 30+%. You're not experiencing that and have to dig out of that hole.
Absolutely.
Yeah.
And what's unique with an Index Universal Life product is even in a bad market, you can capture gains because, it's an annual point to point and it resets every year. So you can start off in your S&P 500 as, let's just say, at 1,000, and then it drops down to 800, and then goes back up to 1,000. You can capture those gains as it's coming back up, even though the overall return over a 12-month time frame didn't increase.
Right.
And so that's what's unique about an Index UL product or an Index Universal Life product.
What about people putting these things on their kids?
Oh, absolutely. There's a lot of people that are, funding policies on their kids for, accumulation purposes. I just always say, make sure the parents have some on them first.
Because, I was going to say, what's the rule on that?
Well, the rule of thumb is, if mom and dad both have $1 million of insurance, you can get up to $500,000 on the kids.
So half of what mom and dad have.
Correct.
Okay.
Correct. But, up to a point, if mom and dad both have 20 million of coverage on them, you're not going to get, $10 million of coverage on a 2-year-old.
No. That'd be nice. Huh?
Yeah.
Wow, that'd be a good college saving plan.
Well, it's it's the magic of compound interest. Think about it. You put a policy on a even a 18-year-old,
right?
And that thing's compounding tax free over all those years. A little bit of money makes it into a big pile of money down the road.
Well, compounding without having to pull out of valleys.
Yes, that's right.
Down market. That's
yeah,
great.
You've eliminated all the downside. The Index Universal Life products have been around for about 15, 16 years, and they're averaging somewhere between 7 to 8% is what they've averaged. And that's a tax-free rate of return. So if you're in a 37% tax bracket, that's an equivalent rate of return of 9, 10%.
Right. Or even greater.
Or even greater.
Yeah, because when I was born, the highest marginal tax bracket was 91%.
Yeah.
It's crazy.
It's going to go up, in my opinion. You're going to see it go up.
I saw some talk about the Congressional Budget Committee looking at 88 possibly being the highest, 60s, 65, 63 being the median, and then also the bottom being in the high 20s, 27, 28.
Well, I can
throw on top of California.
Oh, yeah.
That'd be a lot.
You can guarantee there's going to be some changes.
Oh, yeah.
Yeah, it's going to happen.
Yeah. How soon do you think those changes will come?
It's hard to say. It's hard to say. They've been talking about changing the estate tax as well. Right now, an individual can avoid paying estate taxes with estates that are at 11 million or less. They're talking about reducing that to maybe 3.5 million per person. So anyone that has an estate north of 3.5 million will owe an estate tax. It's hard to say. My crystal ball broke a long time ago, but I would be stunned if you don't see some significant changes in the next, couple of years,
I guess the whole idea is to be proactive.
Yeah.
Get ahead of the curve. Tax-free is tax-free.
Exactly.
Even in a low tax environment, you still want tax-free.
Yep.
In my mind, anyway. Yeah.
Nothing wrong with tax-free.
Yeah.
I mean, these index universal life products are actually a great complement to a person's overall retirement plan. I mean, think about it. Okay. You're retired, you have your 401k plan, you need $100,000 for your lifestyle. The market just dropped 20%. Pulling money out of your equity portfolio, probably not the best idea. Hopefully you can just let it sit there and rebound over the next 12 months. Well, tap into your life insurance policy that year instead, because it didn't go down.
Right.
Overall, that's going to improve your overall retirement plan.
Okay. Thanks for being on, Shawn. You got anything else that you need to tell me about?
Nothing I can think of, other than, hey, give Eric a call. He knows what he's doing.
On a good day. Give me a call. My number is area code 714. Hold on a second, let me get it because I haven't memorized it. 714-643-2500, and my extension is 420. And Shawn and I work closely together, so Shawn will be helping me along with the team that you put with me. I appreciate that.
No problem.
And we'll try to make some stuff happen.
Sounds good.
Thanks, Shawn.
Thank you.